My friends, imagine for a moment that you're watching the foundation of the global financial system being quietly shaken, not by noise or drama, but by subtle shifts in debt, currency, confidence, and faith in institutions. In such times, history shows us that wealth doesn't disappear, it transfers, and more often than not, it flows into assets that have intrinsic value beyond paper. Things like gold and silver. Today, I want to talk about silver, not as a relic, not as a collector's item, but as a strategic asset, one that may be signaling a monumental opportunity for those who see beyond the headlines. When we look at the global economy, it is tempting to focus on the immediate, the numbers, the charts, the short-term indicators. But if we truly want to understand where we are and where we are headed, we need to see the system as a whole to appreciate that economies are complex, interconnected, and cyclical. Every nation, every market, and every currency operates within a larger framework shaped by debts, deficits, interest rates, and confidence. These are not abstract concepts. They are the levers that govern the flow of wealth, the incentives for investors, and the behavior of central banks. History teaches us that the combination of these forces can create profound opportunities and devastating consequences. Consider debt. It is both a tool and a trap. Debt allows nations and corporations to grow faster than their economies would otherwise permit, but it also creates obligations that must be honored. And as debt accumulates, those obligations grow heavier. When debt levels rise faster than productivity, the system becomes stressed. Interest payments consume more of income and government revenue, leaving less room for growth investment or social stability. The investors often underestimate the fragility that accumulates silently beneath the surface. What appears as prosperity can be a thin veneer covering systemic vulnerability. Interest rates, in turn, are the price of money, and they shape almost every economic decision. Low rates encourage borrowing, spending, and risk-taking, while high rates do the opposite. Central banks manipulate these rates in an effort to stabilize growth, control inflation, and maintain confidence in the financial system. But their interventions are not neutral. They ripple through asset markets, currencies, and global trade. A small change in policy can trigger a chain reaction that affects millions of businesses and households. The challenge is that policymakers are often reactive, not proactive. By the time they respond to a crisis, the system may have already shifted in ways that are difficult to reverse. Currency is another critical variable. When the value of money falls, purchasing power diminishes, inflation erodes wealth if it is held in the wrong forms. At the same time, currency fluctuations affect trade balances, investment flows, and the relative attractiveness of different assets. In an interconnected world, one nation's policies can have global repercussions. A decision in Washington, Beijing, or Frankfurt does not stay within borders. It spreads through the veins of global trade and finance. Investors must always consider not only local policies, but the global context, because risks propagate faster than ever before. Confidence, though intangible, is perhaps the most powerful force of all. Trust in institutions, governments, and markets underpins every transaction, every contract, and every investment. When confidence falters, the system reacts violently. People hoard, sell, or move assets, sometimes irrationally, but always decisively. The collapse of confidence is often the trigger for financial crisis. And yet, it is almost impossible to measure until it is too late. This is why history is filled with moments when seemingly stable economies suddenly unravel. Not because of a single failure, but because a cascade of minor stresses reaches a tipping point. What we are seeing today is a convergence of these forces on a global scale. Debt levels are high, interests are volatile, currencies are being tested, and confidence is fragile. Economies are still growing, but growth is uneven and dependent on extraordinary monetary policies. Markets are buoyant in some areas, while other sectors are stressed. Structural imbalances such as trade deficits, resource shortages, and demographic pressures magnify the risk of systemic disruption. And then there are unpredictable shocks, geopolitical tensions, technological shifts, or pandemics which act as catalysts that reveal underlying fragilities. In this environment, traditional assumptions about risk and reward are challenged. Assets that were once considered safe may not remain, so while undervalued opportunities can emerge suddenly for those who are prepared, who study the patterns of cycles, who understand that the economy is a machine governed by leveraged liquidity and human psychology. There are paths to both protection and growth, but preparation requires humility. The system is larger than any individual, and it operates according to principles that are often counterintuitive. Ignoring them is perilous. Recognizing them is empowering. Ultimately, the lesson is simple. Even if the implementation is complex, the global economic system is inherently fragile, cyclical, and interconnected. Changes that appear small or localized can cascade into outcomes that reshape wealth, power, and opportunity. Awareness of these dynamics is the foundation of sound decision-making. It is not enough to react to the present. One must anticipate the interplay of forces, identify vulnerabilities before they become crisis, and position oneself to benefit when inevitable shifts occur. Those who understand the system and who approach it with discipline and perspective can navigate uncertainty with confidence, while those who ignore it are often surprised when the system asserts itself in its own inexorable way. When we examine markets, it is easy to focus solely on price movements, charts, and short-term trends. But true understanding comes from looking at the underlying fundamentals. And few fundamentals are as powerful as the balance between supply and demand in markets for tangible assets. This balance is not not static. It is shaped by human behavior, technological innovation, industrial needs, and geological realities. When supply cannot keep pace with demand, prices are not merely determined by sentiment or speculation. They are anchored by scarcity. And the story of silver in particular is a compelling illustration of how structural scarcity interacts with macroeconomic forces to create significant opportunities. Silver occupies a unique position in the global economy. It is both a precious metal and an industrial commodity. Unlike gold, which is largely held for wealth preservation, silver is indispensable in countless industrial applications: electronics, solar panels, electric vehicles, medical devices, and advanced technologies. As the world accelerates toward a more energy-efficient and technology-driven economy, the demand for silver is not just growing, it is compounding. Each new solar farm, each new electric vehicle, each new semiconductor requires silver in ways that cannot easily be substituted or eliminated. This is structural demand. It does not disappear when markets fluctuate or when investors lose interest. On the supply side, silver is constrained in ways that are often overlooked. Unlike industrial production, which can be scaled relatively quickly, mining silver is inherently limited. Silver is rarely mined as a primary product. It is mostly a byproduct of mining for other metals like copper, lead, or zinc. This creates a natural bottleneck even if prices rise dramatically. Supply does not immediately increase. Mines cannot be built overnight. Extraction, permitting, labor, and environmental considerations create lag times measured in years. This structural rigidity means that when demand accelerates, the market cannot respond instantaneously, and scarcity becomes evident in price movements. The interplay between growing demand and constrained supply creates an imbalance that is structural rather than cyclical. In typical economic cycles, prices fluctuate based on sentiment, interest rates, or temporary shortages. Structural scarcity, however, is different. It is a reflection of enduring realities, physical limits, technological reliance, and the inelasticity of production. When an asset becomes structurally scarce, price volatility can intensify, but it also signals an underlying floor, a recognition that over time, demand will continue to outstrip supply unless extraordinary new sources emerge. Industrial adoption is a key driver of this structural imbalance. Consider the global shift toward renewable energy and electrification. Solar panels, which are proliferating at an unprecedented pace, require silver for their conductive layers. Electric vehicles use silver extensively in batteries, wiring, and electronics. Even in traditional industries, silver's antimicrobial and conductive properties make it indispensable. Unlike other commodities that may see demand decline with changing trends, silver is embedded in long-term structural growth. These forces are largely independent of investor sentiment, which means that even in periods of market uncertainty, underlying demand continues to grow. Another factor intensifying scarcity is the long-term decline in mine productivity. Many silver mines are aging or grades are declining, making extraction more expensive and less efficient. New discoveries are rare and exploration is costly and time-consuming. Combined with rising regulatory hurdles, environmental concerns, and labor challenges, these limitations reinforce a structural deficit. Unlike markets for manufactured goods, where production can be ramped up rapidly, silver cannot be conjured into existence. It must be found and extracted, which is a slow and capital-intensive process. The result is a powerful dynamic. While demand steadily rises, supply growth struggles to keep pace. When market participants recognize this, prices respond accordingly. Unlike speculative bubbles that can collapse abruptly, scarcity-driven price increases are rooted in fundamental imbalances. These imbalances create asymmetric opportunities for those who understand the mechanics, those who wait for conventional signals, or who assume that supply will always adjust to meet demand, risk missing the structural shift that is quietly taking place. It is also worth noting that scarcity is magnified by the way silver is held. Unlike other commodities that are consumed or recycled rapidly, a significant portion of silver is accumulated by investors, central banks, and institutions seeking to preserve wealth. This reduces the amount of silver available for industrial use, further tightening the market. The interaction of structural demand from industry and accumulation by investors creates a feedback loop. Scarcity drives price, which encourages further hoarding, which intensifies scarcity. This is not a short-term phenomenon. It is a multi-year cycle shaped by enduring economic and technological trends. Understanding this requires a systems perspective. One must look beyond the price at the forces shaping supply and demand: geopolitical considerations, mining constraints, technological adoption, and investor behavior. It requires recognizing that scarcity is not a temporary condition, but a structural reality embedded in the global economy. Those who approach silver with this perspective are not speculators. They are strategic investors positioning themselves in a market where the fundamental imbalance suggests a favorable risk-reward dynamic over time. Ultimately, what makes silver so compelling is the convergence of structural scarcity and growing global demand. This is not a fleeting trend or a market fad. It is the product of long-term economic, technological, and industrial forces that are reshaping the way we produce, consume, and store value. Recognizing this reality requires discipline, patience, and a deep understanding of systems, qualities that are the hallmark of successful long-term investors. Those who internalize these dynamics position themselves not only to benefit from price appreciation, but to navigate volatility with clarity and confidence, because they understand that the scarcity driving the market is real, enduring, and largely beyond human control. In financial markets, the concept of value is often misunderstood. Many participants focus on what an asset costs today, its short-term fluctuations, or what others are willing to pay at this moment. But true valuation considers a broader perspective: historical norms, structural supply and demand, macroeconomic forces, and the potential for change in circumstances that may unlock latent value. This is where asymmetric opportunity arises, when the potential upside of an asset far outweighs the downside risk, creating a situation in which the rational long-term investor can achieve favorable outcomes even amid uncertainty. Silver at its current juncture is one such example. To understand asymmetric opportunity, it is necessary to appreciate context. Silver has historically been undervalued relative to other assets, particularly gold. While gold is widely recognized as a store of wealth and a hedge against monetary instability, silver has often been relegated to a secondary role. Yet, silver shares many of the same qualities as gold: intrinsic value, scarcity, and acceptance as a form of money, while offering additional industrial demand that continues to grow. When an asset with fundamental scarcity, industrial utility, and monetary relevance is priced below its historical or intrinsic value, the potential for significant appreciation is substantial. Market participants often underestimate how cyclical and structural forces converge to create this opportunity when debt, inflation, and currency pressures intensify. Globally, investors seek protection in tangible assets. Those who understand the macroeconomic context recognize that silver offers both a hedge against monetary erosion and a potential vehicle for capital appreciation. Unlike equities or bonds, whose value can be eroded by poor corporate performance or credit risk, silver's value is rooted in scarcity and utility. As global uncertainty rises, silver's relative attractiveness grows, creating an asymmetric payoff. The downside may be limited by its intrinsic worth, while the upside can expand dramatically as demand outpaces constrained supply. Historically, silver has experienced moments of explosive appreciation during periods of macro stress and industrial expansion. In the late 1970s and again in the early 2010s, silver prices surged in response to a combination of inflation, geopolitical tensions, and rising industrial consumption. These episodes were not random. They were the result of predictable forces colliding in ways that the market initially underestimated. Today we observe a similar convergence. Debt levels are high. Central bank policies are creating liquidity pressures. Industrial demand is surging, and investor awareness of these dynamics is growing. The conditions for an asymmetric opportunity exist not because of hype, but because fundamentals support it. The concept of asymmetric opportunity is also tied to risk management. Investors often overestimate short-term volatility while underestimating structural drivers of long-term value. A disciplined approach requires separating price noise from fundamental trends. Silver may experience corrections, and these corrections can appear alarming to the unprepared. But when the underlying supply-demand imbalance and scarcity remain intact, these dips are opportunities rather than threats. In other words, when structural forces dominate market behavior short-term, volatility does not negate the long-term potential. It enhances it by creating points of entry at favorable valuations. Another dimension of asymmetric opportunity lies in the comparison of risk versus reward. For an investor allocating capital strategically, silver's current valuation presents a scenario where the expected upside exceeds the downside significantly. If silver remains undervalued relative to historical ratios with gold, and if industrial and monetary demand continues to grow, the potential gains from appreciation are considerable. The risks, while real, are bounded by its intrinsic value as a tangible asset with industrial necessity. This is the essence of asymmetry. A modest investment today could yield disproportionately large returns if the forces driving scarcity and demand unfold as expected. Investors often fail to recognize that markets are nonlinear. Small changes in macroeconomic conditions, supply constraints, or investor sentiment can produce outsized effects on prices when fundamentals are tight. In the case of silver, supply constraints, rising industrial demand, and monetary pressures create a situation where incremental shifts can lead to significant price movement. This nonlinearity is what makes the opportunity asymmetric. Modest allocations can capture substantial gains without requiring perfect timing because the underlying forces are persistent and growing. Timing, of course, is never irrelevant. While one cannot predict the exact peak or trough of a cycle, understanding the broader context allows investors to position themselves with an informed margin of safety. Buying silver today is not a speculative gamble, as a calculated response to structural scarcity, growing demand, and historical undervaluation. Those who recognize the asymmetry inherent in this setup understand that the potential rewards are not merely hypothetical, but grounded in observable trends, economic realities, and the mechanics of supply and demand. Finally, the lesson of asymmetric opportunity is broader than any single asset. It is a principle of decision-making under uncertainty. Allocate capital where potential upside meaningfully outweighs downside risk and where systemic understanding provides a rational basis for conviction. Silver exemplifies this principle at this moment. It is undervalued relative to its historical norms, structurally scarce, increasingly demanded by industry, and protected by intrinsic value. For those who approach it with discipline and perspective, the asymmetry is clear, the potential reward is significant, while the downside, though real, is limited by fundamentals. In sum, the convergence of undervaluation, structural scarcity, industrial demand, and macroeconomic pressures creates a scenario in which silver represents an asymmetric opportunity, Unlike many other assets in today's environment, the investor who sees beyond the noise, understands the drivers and positions accordingly, is not chasing a trend. They are responding to enduring forces that have historically produced outsized returns. In this way, asymmetric opportunity is not speculative. It is strategic, systemic, and grounded in the mechanics of the global economy. Markets are inherently volatile. Prices fluctuate, sometimes violently, in ways that seem irrational to those who focus solely on the present moment. This volatility is not an anomaly. It is a feature of markets, not a bug. It is the natural outcome of human behavior interacting with imperfect information, systemic imbalances, and the dynamic forces of supply and demand. For an investor, volatility is often framed as risk, the fear of loss, the uncertainty of timing, the discomfort of watching value fluctuate. Yet volatility, when understood and approached with discipline, is not merely a danger, it is also an opportunity. The first principle in navigating volatility is recognizing its source. Price swings rarely occur in isolation. They are a reflection of changes in perception, liquidity, and underlying fundamentals. When the market perceives a threat, whether it is a shift in monetary policy, geopolitical tension, or a sudden spike in demand, prices respond immediately. These movements are amplified by leverage positions, margin requirements, and herd behavior. The market often overshoots, exaggerating both fear and greed. It is in these exaggerated moments that disciplined investors find opportunity, because the long-term structural drivers remain intact, even as short-term prices fluctuate. Understanding volatility requires a systems perspective. Markets are not just a collection of independent trades, they are networks of interdependent behaviors, incentives, and feedback loops. A change in one part of the system, for example, an unexpected interest rate decision or a central bank liquidity adjustment, ripples through the entire network. These ripples are not linear. Small triggers can lead to outsized movements, and events that appear minor in isolation can catalyze major shifts in price. Recognizing this interconnectedness allows investors to anticipate potential stress points rather than reacting solely to price movements after they occur. Risk in this context is the probability of loss relative to one's objectives. It is not volatility itself. It is exposure without understanding.